The price moves in silver have been more than entertaining to watch. It's been an emotional roller coaster that has captured the globe. Now, prices have fallen from $120 an ounce down to $55 an ounce, and now it's moving back into the 60s going into the holiday weekend. So if you're looking for expert consensus on where it goes next, good luck. But I will tell you this, I have 4 opinions from different analysts telling you where they think it's going to be going. So stay put. This is Markets Only. Let's break down the silver forecast chaos together. First up, the lease rate alarm. This is one of my favorites. The headline screams silver alert in all caps. Always a good sign of measured analysis, claiming the EFP spread is widening like it did before silver lease rates exploded to 30%. For those not fluent in metals market mechanics, let me clue you in. The EFP is the exchange for physical spread. It measures the premium or discount between futures contracts and physical metal. When it widens significantly, it can signal tightness in physical supply versus paper contracts. And historically, when physical gets tight, lease rates, what it costs to borrow silver, can spike. 30% lease rates would be astronomical. That's not a market functioning normally. That's a market under serious stress. Position 2. Kinesis Money says the bearish metals thesis is dead wrong. No hedging, no maybes. They're calling the bears out directly. The argument here seems to be that fundamentals for precious metals remain strong despite recent price action. We're talking monetary policy concerns, debt levels, geopolitical instability, the usual precious metals bull case. They're positioning this as a buying opportunity, not a trend reversal. 89. That's a significant number if accurate. From 55 to 89 is indeed about 50% gain. So that's what he's looking at here. Thomson says he's compelled to buy. That's strong language, not considering a position or watching for entry points. He's compelled. That suggests conviction. And position 4, Michael Oliver, weighing in on silver's crash to 55. Here's where it gets interesting. The producer notes say this guy was way off, and he was. He was calling for $300 silver by the summer. So we've got an analyst with a questionable recent track record returning to make a new prediction after missing the move. Now, that's either humility and recalibration, or he's going to be doubling down. So we need to see what he's actually saying right now. So what do we actually have here? 4 perspectives that aren't necessarily contradictory, but they're emphasizing completely different time frames and mechanisms. The lease rate warning is about market structure and physical tightness. That's a short to medium term technical signal about supply stress. If the EFP spread really is widening like historical precedent before rate spikes, that's worth watching. Lease rate explosions don't happen in healthy liquid markets. They happen when someone needs physical metal and can't get it easily. That's a supply squeeze setup. Kinesis saying the bearish thesis is dead wrong. That's a long-term fundamental call. They're not necessarily predicting where silver goes next week. They're saying the macro case for metals hasn't broken down despite recent price weakness. Those are different arguments. You can have a strong fundamental case and still see prices consolidate or even drop further in the short term. Markets don't move in straight lines, based purely on fundamentals. Stewart Thomson, calling for a return to $89 is a price target with a specific reference point, the May highs. That requires us to ask, what drove silver to those highs in the first place? And are those conditions still present or returning? A 50% gain from here isn't small. That's not a modest bounce. That's a major leg higher. What's the catalyst? Thomson says he's compelled to buy, which suggests he sees either value or momentum setting up. And then Michael Oliver. Without knowing his current prediction, we know his recent record includes missing silver's crash to 55. That matters. Not because analysts can't be wrong. They're wrong constantly, but because track record gives us context for weighing predictions. If he called for much higher prices before the crash, is he now capitulating? Is he adjusting his time frame? Is he still bullish, but with different parameters? Here's what mainstream financial media typically does with precious metals. Ignores them until they make dramatic moves, then covers the move without context. You'll see headlines like "Silver rallies on uncertainty" or "Silver drops as yields rise," without any discussion of the actual mechanics: lease rates, EFP spreads, physical premiums, delivery dynamics. The structural elements that might actually explain price action get skipped for simple narratives. And that matters here, because if the EFP spread really is widening significantly, that's a data point most casual observers won't see until it explodes into a price move they can't ignore. So where does this leave us? With 4 opinions and no consensus, which means your job isn't to pick the right guru. It is to understand what each prediction requires to be correct. For lease rates to explode, we need physical tightness to intensify. Watch for continued EFP widening, rising physical premiums, and delivery stress. Those are reasonable. For the bearish thesis to actually be dead wrong, we need the fundamental case to reassert itself in price. That means silver needs to hold key technical levels and start building a base, not continuing to break down. For Thomson's 50% rally to 89, we need a catalyst and momentum. What changed between the May highs and now? Can those conditions return? And for Michael Oliver's new prediction, whatever it is, we need to weigh it against his recent miss. That doesn't disqualify him, but it does mean checking his reasoning carefully. The reality is this, everyone. Silver at 55 after a significant decline presents either opportunity or further risk, depending on what happens next in physical supply, industrial demand, monetary conditions, and investor sentiment. The experts disagree because they're weighing these factors differently and looking at different time frames. Your edge isn't in picking the right prediction. It's in watching which scenario actually develops and positioning accordingly. Track the EFP spread. Watch physical premiums. Monitor whether support holds or breaks, and keep the score on who called that. Because when the lease rates do move, or silver does rally, or breaks lower, someone's going to claim they saw it coming. And we'll have the record. So, tomorrow, we'll be tracking more market predictions and holding the forecasters crowd accountable. Stay tuned to Markets Only as we examine the markets and navigate the chaos together.